This video is brought to you in partnership with the Investors Podcast Network, but more on that later in the video. Even the best investors in the world make mistakes, and as Monish Prabrai will tell us, it's much cheaper to learn from the mistakes of others than it is to go out and make those same mistakes yourself. So in this video, the first in a three-part series on famous investment flops, I want to look back at Warren Buffett's very first tech investment where he bought over 80 million shares of IBM. We'll talk about why Warren Buffett liked IBM in the first place, what went wrong, what his losses were, and what we as everyday investors can learn from the situation. If you enjoy the video and haven't subscribed to the channel already, please be sure to do so. And before we get into the video, a quick shout out to the Investors Podcast Network. For years on the show We Study Billionaires, the Investors Podcast Network has made a habit of chatting with the world's best investors like Ray Dalio, Joel Greenblatt, Howard Marks, and many more. With over 100 million downloads, they make podcasts by investors for investors. Now they're joining the newsletter space. You can now read the Investors Podcast Network's full daily commentary and expert insights in the We Study Markets newsletter. Check out the first link in the description below to sign up free for that newsletter today. So what is IBM and why did Warren Buffett make this investment in the first place? Well, IBM is actually quite an old company at this point. They were founded right back in 1911, and as you might expect, in the 100 years between their founding and then Warren Buffett making his first investment in the stock in 2011, the company had evolved a fair amount. In the 1960s and 70s, they sold about 70% of the world's computers. But by the time Buffett had invested in 2011, they had divested their personal computer business. They sold that arm of the company to Lenovo in 2005. And their specialty really, when Buffett made his purchase, was in mainframes and IT software and services. For a long period of time, IBM systems had been very dominant, and they were certainly entrenched in many large US and global enterprises. Now, in terms of what I think Buffett liked from an investment perspective with IBM, besides the business being maybe on the edge of his circle of competence, with it being sort of his first big bet in the technology space, kind of that aside, I think it was very much kind of a textbook investment for Warren Buffett. First off, IBM was a company with a very long history in the United States, being 100 years old, pretty much exactly at the time that Buffett made his first investment. Secondly, it was trading at a relatively modest price versus what it was earning at the time. It traded at a low double-digit multiple of earnings and even a slightly lower multiple on an enterprise value basis. We know that Warren Buffett loves companies that repurchase their shares over time, and IBM was a pretty aggressive repurchaser of their own shares. And Warren Buffett actually wrote about IBM and used them as a specific example in his 2011 letter to Berkshire Hathaway shareholders. He said, "Today, IBM has 1.16 billion shares outstanding, of which we own 63.9 million, or about 5.5%. Naturally, what happens to the company's earnings over the next 5 years is of enormous importance to us. Beyond that, the company will likely spend $50 billion or so in those years to repurchase shares. Our quiz for the day: what should a long-term shareholder such as Berkshire cheer for during that period? I won't keep you in suspense. We should wish for IBM's stock price to languish throughout the 5 years." Buffett went on to say in that letter, "In the end, the success of our IBM investment will be determined primarily by its future earnings. But an important secondary factor will be how many shares the company purchases with the substantial sums it is likely to devote to this activity. And if repurchases ever reduce IBM's shares outstanding to 63.9 million, I will abandon my famed frugality and give Berkshire employees a paid holiday." So for all those reasons, Buffett went ahead and started purchasing the stock at the beginning of 2011. And I'll put on the screen here basically Buffett's purchase history over time. You'll see that he actually continued to add to the stake right through until about 2016. And in fact, he bought so much IBM stock that it became, at one point in time, the second largest position in Berkshire Hathaway's portfolio. It was kind of right there neck and neck with Wells Fargo, and it was right behind their biggest investment at the time, which was Coca-Cola. So what ended up happening with IBM, and where exactly did this investment go wrong? Well, I want to kind of break that into two parts. Firstly, looking at what happened with IBM's core business, and second, we'll have a look into what happened with the stock, because that actually was not as bad an outcome as what happened with the underlying core business, and we'll get into that later in the video. So firstly, in terms of what IBM were planning to do with their business, the incoming CEO at IBM, Jenny Remedi, had really been trying to transition the business away from their older kind of legacy mainframe business to a more modern cloud offering. But IBM was, and to an extent still is, a very large and kind of slow-moving ship. And more or less that transition happened a lot more slowly than investors and Jenny Remedi herself had maybe hoped for. And essentially IBM was simply outcompeted by some of the newer, more nimble and faster-growing competitors, the likes of Amazon's AWS, Amazon Web Services, Microsoft Azure, and to a lesser extent Google Cloud. And through that slowness to transition and the increased competition from some of these newer cloud competitors, IBM just flat out earned less profit over the few years that Buffett owned the stock. In 2011, IBM earned $15.9 billion, but by 2017, that had decreased to as low as $5.8 billion. And over that same period of time, Amazon's AWS cloud offering had grown its revenue from essentially zero to about $25 billion, and it was really showing absolutely no signs of slowing down. So what ended up happening with Buffett's investment in the stock? Well, the results actually weren't as bad as the results in the business and the massive decline, the about 2/3 decline in earnings that IBM experienced. The buybacks at IBM were executed, and the shares outstanding did decrease pretty significantly. About 25% fewer shares existed when Buffett eventually got out of IBM compared to when he first bought into IBM. But as the earnings at IBM declined, the rate of share buybacks and repurchases also declined. They simply had less cash around to keep buying back their own stock. And for the 6 years or so that Warren Buffett owned IBM shares, the stock went more or less sideways, maybe down a little, but it was basically very flat was the overall sort of result for Buffett. And eventually, given the decline in IBM's ability to earn money and the decline in their underlying intrinsic value, Buffett eventually kind of threw in the towel and decided to sell the stock. And I want to play two clips here from a couple of different Warren Buffett interviews. One, he explains the very simple reasons why he would even think about selling a stock in the first place. And secondly, he tells us why he specifically sold IBM.
We'll sell a stock for one of two reasons. If we need the money to buy something that we like even better. Now that's almost never a case at Berkshire because the money keeps coming in. So that was the case 20 or 30 or 40 years ago, but it's not the case now. And now we'll only sell something basically if we think that the company is not worth what it's selling for.
Recovery process.
Well, they may well do extremely well in the future, but I was wrong in my original analysis. And that's my fault. So 5 or 6 years ago, I thought that their prospects were going to be better in the next 5 or 6 years than they turned out to be, significantly better. And so I decided that I had made a mistake. That doesn't mean sometimes I make two mistakes. Sometimes I make a mistake when I buy and when I sell. But so I still don't know that much about the future, but I feel more certain about the future as I look at a company like Apple than when I look at IBM now.
So after Buffett made the decision to sell out of IBM, what were the eventual returns or lack thereof that Warren Buffett generated? Well, to my knowledge, Buffett has never come out and specifically disclosed how much money he gained or lost through his IBM investment. But we can get a rough estimate of the prices Buffett likely paid for the shares and then likely sold the shares at, just based on the timing of Buffett's 13F filings, what the share price of IBM was doing at the time, and how many shares he was buying and selling. So a few estimates I've managed to track down are that Buffett probably paid on average about $175 a share to make his investment in IBM, and over the period of time that he sold the stock, he probably managed to capture about $150 a share. Now, I've also got to keep in mind that IBM is a dividend-paying stock, and throughout the period of time which Buffett held the shares, he probably received about $30 per share in dividends, or maybe a little under $30 per share in dividends. So even though he took a $25 to $30 per share loss on the stock price, he basically regained, exactly that amount, or maybe even a little bit more, through the dividends he received from the company. So all in all, it was probably about a break-even or maybe even modest gain sort of investment for Buffett and Berkshire Hathaway. But what makes this investment in IBM really painful is really just the opportunity cost. Over the same period of time that Buffett had all this money tied up in IBM, a really big position in his portfolio, the S&P 500 more than doubled. It was up over 100%. And there were almost certainly other opportunities that Buffett could have taken, within the basket of American businesses in which he can invest. And so the relative performance versus the index was very poor with the IBM investment. And although there weren't substantial losses, there was certainly a big opportunity cost for Berkshire shareholders. So what can we learn here from Buffett's experience with IBM? Well, in my view, the biggest takeaway here is actually the fact that Warren Buffett made a pretty significant mistake in terms of his judgment about the future performance of IBM, but he managed to invest with a margin of safety so that he actually experienced basically no losses over the period of time in which he held the stock. I'm fairly confident in saying that Buffett, when he made the investment in IBM, expected their earnings to grow out into the future, but rather their earnings declined by about 2/3 over the period of time that he held the stock. So how on earth did he manage to escape that sort of situation with fairly minimal losses in his portfolio? Well, first of all, he paid a very modest multiple of earnings, probably somewhere in the 13 to 15 times earnings range, and an even lower multiple on an enterprise value basis, like I said earlier in the video. He also really liked the capital allocation at IBM, where they were retiring a lot of shares, and that certainly helped his cause. If we look from 2011 to 2018, when Buffett owned shares of IBM, the market cap of IBM declined roughly 25%, yet the share price was flat, and that was basically because IBM was able to shrink their share count by about 25% via all of these share repurchases. And in a couple of specific years, the shares repurchased by IBM were pretty astounding. In 2014, they retired more than 8% of the company's shares outstanding. And Buffett also got a fair chunk of cash back in dividends. Probably about 15% of his initial capital was simply paid back out to him over the 6 or so years that he owned the stock in the form of quarterly dividend checks. So between the buybacks and the dividends, there was sort of a lot of risk taken off the table, especially when combined with the modest valuation that Berkshire and Buffett paid to make the initial investment. I hope you enjoyed this video about Warren Buffett's fairly mediocre investment with IBM through the 2010s. Be sure to keep an eye out here on the channel for part 2 and part 3 of this short investment flops series. And check out the first link in the description below to sign up for free to the We Study Markets newsletter. But that's it from me for this one, and I'll see you in the next video. Cheers.